Good day, investors. I'm your host, Jared Bowers. I'll start off with a question for you. How would you feel if the coach of your favorite team benched the team's best players when they were down, and there was a whole lot of game left? You probably wouldn't be writing that coach a thank you note. Let's push pause on that for now, as we will come back to it later. But I have another question for you. My next question is, how bad do you feel for those people from the case studies from the last episode? At least the two of them that I was critical of. We heard 3 stories in that last episode. The first started us off strong, and the last 2 ended on a sour note. You might not feel one bit bad for that last couple that we talked about. The ones who successfully figured out how to turn a nice big $30 million fortune into a much smaller $4 million fortune. You might also not feel bad for that backseat driver who hated his job, was trying to retire early, but handicapped his portfolio in his quest to get rich quicker. He tried to widen the door on the escape hatch, but every time he tried, he just made it narrower. Rich folks who are bad with their money don't make for very sympathetic figures. Well, I'm not asking you to feel bad for them. What I'm asking you to do is to learn from them. Last time I told you the stories. Today, I want to talk about the mechanisms, tendencies, and drivers underneath those stories. We're going to dig into the mindsets and reasons behind why people respond the way they do in the markets and how to adjust our settings so that we can avoid similar mistakes. I'm guessing that you're like me in this way. I prefer to learn from other people's mistakes rather than my own. Maybe less powerful than making them ourselves, but a lot less expensive. And can be just as powerful if we really take these lessons to heart. We tend to lean one way or another between fear-dominant or greed-dominant. Fear-dominant investors are mostly afraid of losing what they have. Greed-dominant investors are mostly afraid of missing out on what someone else is getting. But you can see the threads of fear and greed through both of those case studies we talked about last time. And even though they would see nothing of the other in themselves, you can see the connections despite them being pretty different cases. Both are operating primarily out of fear and greed. One of them just happens to be stronger than the other at different times of the market and in response to different movements of the market. Rodney was mostly greed dominant. He wanted the shortcut. He wanted the edge. He wanted the special thing that would get him out of the job that he hated. Mike and Kim swung back and forth. Greed pulled them at the top. Fear pushed them at the bottom. Those sound like opposites. But in the market, they often produce the same bad behavior. Buying after prices have gone up and selling after prices have gone down. These are 2 extremes, but in my experience, they are common attitudes and approaches when it comes to investing. I'm going to talk a lot again about liquidity and volatility in this episode. They go hand in hand. And as we dive into our topic at hand, a reminder. Liquidity is generally seen as a universally good thing, and it can be a good thing. Liquidity is most useful when it gives us the ability to put money to work, rebalance intelligently, or sell for a legitimate purpose. When used correctly, liquidity is wonderful. But it takes discipline and the right mindset. And the right mindset is easy when things are good, or going up for the most part. But liquidity becomes dangerous when it gives us the ability to act on panic, impatience, or fear of missing out. These tend to be the most common and wrong ways that liquidity is used by most people. The best way to avoid being caught up in that fear and greed cycle of the markets is to stay invested. Liquidity is a powerful tool that most use poorly. A double-edged sword. That's a theme that continues to come up, isn't it? Not inherently good or bad on its own, depends on how the tool is applied. We'll push pause on that discussion on liquidity because I have another reminder for us. Volatility is generally seen and talked about as universally bad. But we know that it's not that simple. When it comes to the fear-driven side of us, it's difficult to practice the right mindset and actions in the face of downward volatility. whether we continue to hold or buy into downward volatility, or, on the other hand, whether we give in to that fear and panic and sell. And the way that most people behave results in the poor decision of selling low and buying high. What we need is a reframe of volatility. So consider this. The downward volatility is the cost, and the upward volatility is the benefit. You don't get a benefit without a cost. That is a universal rule of life. Volatility isn't the problem. Volatility in the wrong direction for the wrong reason that doesn't reverse is the problem. We need to remember that without volatility, there are not returns. People forget that volatility is also on the upside. And we want to hold investments that are, over time, volatile upward and to the right on the return chart. Volatility is the price of admission, and it is a price that is worth paying. And it is a worthwhile price to pay in our path to investing in positive asymmetry investments. Those investments, opportunities with more upside than downside. And I've said this a few times already over the past episodes. Volatility is dangerous in that it tempts us to do the wrong things. Liquidity is dangerous in that it gives us the opportunity to do the wrong things. But again, on that need for a reframe, leaning into volatility is the only way we get returns. And when we have the option to make the investment that liquidity gives us, we should. We would do well to learn how to use the right edge and avoid the wrong edge of this double-edged sword. Let's now talk about timing the market. More accurately, trying to time the market. Where I see the downside, the wrong edge of the sword of both liquidity and volatility manifests most often is in this universal urge to think that timing the market is a good idea. Recall our friend Rodney from the last episode. Even intelligent people like him think that the right thing to do is to try to time the market. Now, I will freely admit that there are better and worse times to buy and sell in the market. You can probably recite along with me the most common mantra that's repeated about the market's ups and downs. We should buy low and sell high, right? And if you're going to buy or sell, it's mostly a good rule of thumb. There's more to unpack on that common saying, and we'll do that in a little bit later in this discussion. It's easy to sit here and analyze in a calm market, in the safety of things feeling pretty normal. And it's easy when our money is not at risk and say, of course I'm going to buy low. Of course I'm going to take advantage when things are cheap. I'm going to do the right thing. Of course I'm not going to sell when the market goes into a free fall. I'm going to take advantage of it as an opportunity to buy. Of course I am. At least that's what we tell ourselves. But that is not what behavioral psychology suggests will happen. And that is not what reality and history, including my own experience, tells me will happen. Because we have this thing that is powerfully built into us called loss aversion. We hate loss. We want to avoid it. For the vast majority of us, we feel the pain of loss much more strongly than we feel the pleasure of gain, to the tune of 2 or 3 times more strongly. Which means that from a psychological standpoint, it would take a $40 or $60 gain to produce the same happiness that offsets the pain of a $20 loss. Again, we feel the pain of loss so much greater than we feel the pleasure of gain. But coupled with the other powerful inborn psychological trait that most of us have, positive hindsight bias, which is our tendency to rewrite our negative past experiences as less negative or even as positive over time, most of us aren't paralyzed by our amplified near-term feeling of loss. That's because as time passes, we don't remember the loss as bad as it was when it happened. This combination is amazing, not because it produces the best results. It's amazing because these two opposing tendencies offset and mostly balance each other in a way that allows us to keep living and keep investing. But that doesn't mean that our tendencies are doing us all favors. When it comes to volatility and liquidity in the markets, it's quite the opposite. The tendency to feel losses more powerfully than we feel gains, which drives us towards loss aversion, is why it is rare that I am able to convince someone to put their money to work when prices are going down, when things are in free fall. Unless it was their idea, or unless I already have control over their money and am able to make that decision myself as their portfolio manager, people by and large run away from price drops. Rather than do the right thing, we can all recite yet don't practice. Buy low. When prices are falling, I'm generally not answering questions from my clients about what to buy. I spend much more time, probably a ratio of 5-to-1, talking people out of wanting to sell on the way down. And my point in bringing this up is that my clients are a representation of people who know how to build and manage wealth. And even in that high quality sample, many tilt towards the temptation to sell into downward volatility. But thankfully, they have wisely managed for that tendency by outsourcing those decisions to me. But the temptation and tendency is still there. And if it's 5-to-1 for me, I imagine that the ratio for the general population is much worse. And the reason for that is our drive towards loss aversion. We hate losses so much. People do not sell when offered the best price. They tend to sell when the prices are falling. It's the herd behavior of the market. When the stampede starts, nearly everyone runs in the same direction, and very few pause to check the fundamentals. Even though we may know the phrase buy low and sell high, we often do the opposite. Or at least we feel the pull toward doing the opposite. And when people do sell, whether it's high or low, there's another outcome, there's another behavior that the typical investor has. They tend to not buy back in until the prices are back to or above where they were when they had sold. The average trader thinks that when they sell, all will be well because they will just buy back in once the price is lower. It'll be great, just you watch. The problem is that the market overall, and especially high-quality companies individually, tend to live at or around all-time high prices. They tend to set new all-time high prices pretty frequently because their growth is driven by fundamentals that are also growing. Their growth is driven by something real. They're selling more product or service. They're making more profit. They're serving their customers. So because of that, selling at a high point is not a wise strategy in most cases. All you're doing is removing the ability to keep growing and keep compounding into the future. Selling while it's going down is even worse, because downs tend to happen quickly and are unpredictable, and prices tend to recover quickly as well. The timing of the recovery is also very hard to predict. All right, now you may be thinking, Jared, it sounds like you're telling me not to sell high and not to sell low. So when can we sell? Great question. And this gets to the nuance of the advice, buy low, sell high. The question, the decision, isn't just about price. It's about price compared to value. I do sell holdings in my portfolio and in my clients' portfolios. I sell when I find a better company to replace it with, a better use of that money, or that I've determined that the price cannot be justified by its fundamentals. The price is a factor, but it is the smallest and least important piece of the decision. As I mentioned, many of the companies that I own, that are available to all of us to own in the market, spend a lot of their time at or near all-time high prices. And I'm often happy to buy more at those prices because the companies are growing, and those prices are supported by real earnings and real cash flow. The fact that it's at an all-time high price is irrelevant if it's supported by strong fundamentals. I recently talked through this with someone, and it was a light bulb moment for them that I don't really spend time considering whether the company is at an all-time high or not. The point isn't to buy at a price that is significantly lower than its previous record. The point is to buy good value and then hold on to it for long enough for it to compound. Warren Buffett, of course, already said it better than I could. It's much better to buy a great company at a fair price than it is to buy a fair company at a great price. I'll say it again just to make sure that it's clearly understood. It is much better to buy a great company at a fair price than a fair company at a great price. A company at an all-time high can still be an attractive buy if the value of the business has grown faster than its price. On the other hand, a company down in price, even 50, 60, 70%, can still be expensive if the fundamentals have collapsed or were never there to support it. And when I do sell something, the funds don't just sit there in cash unless there's a very specific reason for it. It gets invested back into businesses, into companies that represent better value, or that represent better growth opportunity going forward, or both. That is not timing the market. That is disciplined and sound portfolio management. And the most important part of that whole formula is that the money stays invested. The way that buy low, sell high gets applied, even if someone happens to get the sales timing right, meaning they sold at a high point, those funds end up sitting out of the market for a period of time. That results in locking in current values and removing the ability of the portfolio to keep growing. And that brings us to the re-entry fantasy, as I call it. Those people think, I'll buy back in when the price goes low enough. Or they think, I'll buy back in when it feels safe and calm again. That is loss aversion. Deciding when and whether to get out may sound like the hard decision. It isn't. Getting back in is the hard decision. What actually happens is that people tend to sell on the way down, or they sell on the way up, or where they sold at wasn't a peak in the first place. The price recovers or keeps climbing higher. And then those people tell themselves, nah, it's going to go lower. It's going to go down. I'm smart. I was right to sell. It's still too expensive now. They're not just waiting for a lower price. They're waiting for the market to tell them they were right, which unfortunately is not one of the market's customer service features. And another powerful thing about human nature is that we feel like we have to justify our actions. We often will continue to do the wrong thing, hoping that things change, that circumstances change, to prove that we were right. So people who do this wait for that drop to come that never comes. And they completely miss out on the recovery, or they just watch the stock they sold keep going higher and higher in price. That is where that loss aversion discussion from earlier comes back into play. We feel the pain of losses so much more sharply in the moment. So selling feels like relief. It feels like wisdom. It feels like finally taking control. But then time passes, and our memory starts to clean up the mess. We tell ourselves that it wasn't that bad of a decision. We had good reasons. We were being prudent. We were protecting the family. We were waiting for the right opportunity. We jumped toward loss aversion, selling when it's down to protect ourselves from further losses because it hurts so badly, which is exactly the wrong thing to do. But then we easily justify those actions later as not so bad because of our misremembering selves. That makes for a really bad behavioral combination when applied to our investing tendencies when we are facing a volatile market in a fully liquid environment. That combination is dangerous. Our fear of loss pushes us out of the market, and our faulty memory helps us justify staying out. I'll go ahead and say that one more time. Our fear of loss pushes us out of the market, and our faulty memory helps us justify staying out. I've seen this story play out so many times. And let's talk a bit about I'll get back in when it feels safe. Well, volatility is always going to be there. The ups and downs are what makes things feel unsafe. Let's use Rodney from our last episode as the example here. When Rodney is out of the market, those sharp swings up and down feel like instability and danger. And not just the downward swings, but the upward ones as well. But if he had been invested in the market, he would at least get to benefit from those upswings. And if he was lucky enough to actually sell before the prices really did go down, then when it does go down, he tells himself that it's probably going to get worse. So he waits. He clutches his cash in his sweaty, nervous palms and feels secure in knowing that it's still there. It's still safe. And the longer he waits, and the more the market goes down, the smarter he feels. The lower it goes, the more right he seems to be. And unfortunately, that tempts him to stay out even longer. Because when a price reaches a low point and starts to go back upward, the people sitting on the sidelines almost always have the same response. Nope, this is a temporary bounce. It's definitely going to go back down. It's going to go lower. That is their response, almost every time. And that makes sense in the moment because prices do bounce on their way down. They have little ups and big downs, then some more ups and some bigger downs. So Rodney and people like him, they see an upward movement and they say, that's just a temporary blip. It's going to go lower. I'll be able to buy back in even cheaper, which will make me even smarter. But The thing about markets and companies is that they tend to drop fast and recover fast. And you cannot pick out a recovery pattern versus a continuing price decline pattern. And that makes timing things nearly impossible, even for people who are paid a lot of money to figure it out. Keep in mind, most cases of timing the market correctly are simply luck. And if most professional traders get it wrong, most of us, traders like Rodney, are going to get it wrong. When that price recovery happens, it often happens rapidly. And there's no announcement that the recovery has started. And the Rodneys, who are waiting for things to feel safe, miss out completely on the chance to buy in at lower prices. The investors who do well, the Harrys, are the investors who just held on, rode it in both directions, and stayed invested. Most people trying to time the market tend to sell closer to the bottom and buy back in closer to the top. And even if it's not exactly timed that way, it results in worse outcomes than if they had just weathered through. So many people think that they are the exception, that they aren't gambling. They believe that they're being prudent and smart to try to time things, and they are wrong. I guarantee you that Rodney and Mike and Kim believed that they were being smart, prudent, responsible, doing exactly the right thing. But they were doing exactly the wrong thing. And just to make sure that we're on the same page, I want to make clear that timing the market is different than applying the appropriate portfolio management technique of rebalancing, trimming things that got too big or expensive, and investing those proceeds into companies that represent better value. The way that I describe my portfolio management approach of rebalancing might sound to some like I'm doing some of these same things that I'm preaching against. Like I'm trying to do the sell high, buy low in the gambling way that I described. But again, the biggest difference with that approach of prudent rebalancing by a disciplined portfolio manager versus the way that buy low, sell high is applied in general is that the portfolio manager is staying fully invested based on fundamental drivers of value. They're not interrupting compounding, not taking away the chance for the portfolio to grow. And that is the biggest and most important difference. And it is a big one. If all people did in those situations was stay invested, I believe that 99% of them would be better off. It definitely would have helped Rodney, and it most definitely would have helped Mike and Kim. But it is that constant pricing and that instant liquidity that can get us in trouble. The temptation and opportunity to do the wrong thing. Market timing says, I'm going to step out of the game and wait till it feels better. Rebalancing says, I'm going to keep my money working, but I'm going to move it to where I believe it is better allocated. That is all the difference in the world. And the markets prove this. And my own experience and the experience of many people that I've worked with prove this. And I don't think it's unique just because it's with money and with the stock market. Remember our discussion from episode 24, when we talked through that thought experiment of what life would look like if everything that had value was securitized, traded on the market, and fully liquid. The conclusion that we came to is that that would be a really bad thing. We would sell at the wrong times. We would wait to buy when we should just be consistently buying. We would handicap or completely sabotage those important areas of our lives because of our responses to the moves of the market. If we can identify that with the other important capital balances of our life, if we can see that having constant pricing and constant liquidity would likely result in worse outcomes, and therefore we are fortunate that those areas are illiquid and unpriced, why don't we believe it when it comes to our money? We still have the opportunity to make deposits and grow those balances even in an illiquid state. The opportunity is almost always on the add side, not on the subtract side. We grow on the buy side, not on the sell side. And most people lean towards subtraction when prices move rapidly, and they think that they're doing the right thing. But the best thing to do is to push the buy button when we have the chance. Buying when things are normal, buying good things when they're up, and buying when they're down. And doing that last one is really, really hard to do. And again, we've all heard it. We all know it. We all think that it's the right thing to do to buy low and sell high. It sounds like good advice. But that's why, when I hear it from people and I see how it is applied, My most common thought is, you keep using that phrase. I do not think it means what you think it means. We now have a reframe of that piece of advice that is going to result in a lot more wealth and a lot less headache. Spend most of your time buying and only sell when you absolutely need to. Sure, go ahead and accelerate your buying when things are down, but that is less important than just buying consistently over time and avoiding unnecessary selling. Only sell when it no longer fits your parameters from a fundamental standpoint, not simply from a price standpoint. And then get those resources working again. Get them back in the market. Buying and selling simply based on price has got to be the dumbest reason to do either. I'll go ahead and talk out both sides of my mouth here a little bit, because action can be the right thing to do. And more money can be made on the action side. But again, it's on the buy side. I spent a lot of time already talking about bad examples and bad decision making when it comes to volatility, liquidity, and our investment portfolios. But I do want to talk about some good examples, to the credit of a number of people that I know. I have had many situations when prices are falling where clients and people I know want to buy into that opportunity. It's not as common as wanting to sell, but it does happen. And buying into low prices is often a good idea. This is not market timing in a gambling sense. This is not jumping in and out based on feelings or headlines. This is disciplined rebalancing. It is taking advantage of better prices. It is taking money that is available or money that is already invested in something else and reallocating it toward better long-term opportunity while keeping the portfolio working. And I do know people who recognize when there's an opportunity to buy. And to those I say, heck yeah. There's almost always a good place to put money, even when prices are up. But there are a lot of good places to put money when prices are down. Yes, they might go lower. And honestly, my expectation when investing into downward volatility is that I am likely going to be buying things that are going to keep going down even more for a period of time before they come back up. That is just part of it. Did you catch the end of what I said? Before they come back up. That is the reason I don't care that prices will probably fall even lower, because the long-term result is going to be positive. As we talked about, it is rare that someone perfectly catches the bottom, so don't bother trying. If you do, congratulations. You probably tripped and accidentally landed there. Just be glad that you can buy things when they're on sale when you have the opportunity to. Most of the times I've invested into downward volatility, I've run out of opportunity before I've run out of reallocation budget, meaning that the opportunity goes away before I can fully take advantage of it. And that's because those companies are being pulled higher by their fundamentals. And there have been other times when I've fully taken advantage of a reallocation when prices went lower, and then the prices keep going lower. I technically would have been better off waiting, but not really, because waiting means that I started playing the timing game. When I recognize that there's an opportunity to reallocate and take advantage of lower prices, I am going to take advantage of it, even understanding that the prices may go quite a bit lower from there. I don't dwell on the what ifs. I have a system and a process that I use when markets fall to put money to work through rebalancing. It works well. I might get into the specifics of that in the future. But first, confession time. Even I, as a professional portfolio manager who preaches and teaches this to my students, to my clients, in podcasts, even after the past couple decades of investing through multiple down markets, even with all that experience, it is hard for me to do the right thing sometimes. Oftentimes. It is hard for me to do the right thing in the face of volatility, having the optionality that liquidity gives me to do the wrong thing. But when given the opportunity, I usually do buy when things are going down. And I buy with the proceeds from trimming or selling the positions that are still up or are not as fundamentally strong, that I have less conviction for. There are not very many people who have a consistent track record of doing that. That is because it is a very hard thing to do. This next part is interesting to me. Most of the time, when there's an opportunity that results in some being better off and some being worse off, it requires a specific kind of action and skill to take advantage of it. Action is required to get the benefit. If you're placing a bet or trying out for a team or trying to win a game, the win is a result of the actions that you take. But when applied to financial investing, it's usually the opposite. To get the best results, it mostly requires not doing something. In most cases, the better outcome is achieved when we don't do anything. Again, assuming that we are invested, that we don't sell when prices are falling, that we don't buy only when prices are climbing. We should spend most of our time buying and holding and spend a little bit of our time appropriately rebalancing. And most of the time, what that is not doing much of anything at all. And this throws a lot of people off, because advantage is gained in most things in life on the action side, not on the inaction side. So doing nothing feels like the wrong thing to do, to not be jumping towards action in the midst of volatility. Yes, liquidity is a tool that gives us power and gives us options. Yes, volatility results in opportunities. But financial investing is weird, because much of the advantage comes from not doing the foolish thing that's available to you. But here's why it works. Once you are invested in quality assets, doing nothing is not nothing. It is holding. It is staying invested. It's refusing to interrupt compounding. You didn't remove your capital from its ability to generate future returns. You didn't pull your players on the sidelines. You are actively choosing to stay invested. And speaking of sidelining your players, and calling back to our opening question, let's talk through a sports analogy to set this in our minds. Imagine a coach who was recently hired to coach a team of strong players. But this new coach has two really bad habits. The first bad habit is that he pulls his best players and puts them on the bench when they're up in a game to keep them safe, even though there's a whole lot of game left to play. Very thoughtful, but very terrible coaching. He takes his best players off the field when they're up, when it's not anywhere near the end of the game. And the number two bad habit, he forfeits games when they're down to keep the loss from getting even more lopsided, to stop things from getting worse. Now, those two things might already sound crazy to you, but let's add this additional layer to it. I mentioned it's a strong team that generally wins. But this team wins 70% of the time. So in an average 18-game season, that's 12 or 13 wins and only 5 or 6 losses. And let's assume that that team has kept that track record for decades. If we apply this to a different sport, in an average 82-game season, that's roughly 57 wins to 25 losses. That is a strong team, right? An incredibly strong team if it's kept up that track record for decades. That is a team that is going to be in the playoffs nearly every year. They're going to be a title contender multiple times every decade, and they're probably going to win a few titles along the way. Yet they now have a coach that behaves in those two ways. Benches their players when they're up and forfeits the game when they're down. And as a fan of this team, you would be screaming at your TV that they needed to fire that coach. But it gets worse. Let's add an additional wrinkle to this analogy. This game we're talking about is not a time-limited game. Most sports that we watch, I guess all sports we watch, the games eventually end. Even ones that go into multiple overtimes or multiple extra innings. They will eventually end. But this game that we're talking about doesn't have an end. It keeps going. It is a perpetual game. So now having all the facts, that the team wins far more than it loses, and that the games keep going, that makes those two bad habits of the coach even worse, even crazier. Pulling players when they're up, forfeiting when they're down. That coach should be fired. They would be fired. That coach would never again be allowed to make decisions in a game. And that type of approach when it comes to coaching a strong team, we can clearly see is bad. And you can see where this is going. We, investors, participants in the market, have the tendency, the temptation, and the opportunity to do exactly this when it comes to one of the most important games that we play, investing in our financial future. The stakes are high. And the sad thing is that the implementation of that terrible strategy that I just talked through is quite common. Yet, so many people tell themselves that it is a smart strategy. They rationalize that it is the right thing to do. Pull your capital out of a long-term, perpetual, positive expected return game. In this case, owning companies that are generating real value for real customers into the future, long-term. That is the same as if you got down by a couple touchdowns in a football game or a couple goals in a soccer game and you say, oh man, I don't want to put my players at risk of losing even more. I better take them out of the game. I have to protect them. All they did in that case was lock in their loss. They guaranteed their loss. And they removed any chance of scoring points, any chance to win. Or, when they're up, they call the game. But that doesn't work because the game keeps going. And so all they did was just take their players off the field. The game keeps going without them. The points that could have been scored will never be scored because that excellent team was completely removed. And even in a sports game, where it is for a limited duration, that sort of strategy does not make one bit of sense. There's a difference between tough and crazy, coach, and you're not flirting with it, you're just plain crazy. We can recognize that. But what makes it even worse in real life, when it comes to our money, in the markets, is that it is a perpetual game, a never-ending game, which makes the strategy even worse. Much, much worse. Because the upside that is being limited or giving up is so much greater. Pulling your money out, selling your investments that have long-term expected payoff, whether it's when things are down or when things are up, is a really, really bad strategy. There's this little thing we talked about recently, and by little, I mean massively big and important thing, called the asymmetric return profile of the market. It's a bit of a mouthful, yeah, but it's pretty dang important. Because if you grasp it, if you fully understand it, and if you invest accordingly, it is life-changing. It is perspective-altering. As a refresher, fundamental long-term investing has limited downside and unlimited upside. The downside is limited to what you put into it. The long-term potential payoff is massively positive, theoretically unlimited. That doesn't mean there's no downside. That doesn't mean that we ignore risk, but it means that when you pull your capital out of the game, you are not just protecting yourself from more downside. You are also removing yourself from the upside. And over long periods of time, in a perpetual game with positive expected return, that upside is the whole point. Financial markets are not the only assets where this exists. Relationships are one of them. Way more upside than downside, even if risk exists. A meaningful career is another one. The investments that we put into our health have an asymmetric return profile as well. Much more upside than downside. Really getting involved in a community, putting down roots, owning things in life. In most cases, much more upside than downside. Limited downside, probably unlimited upside. And if we interrupt compounding, if we sell into downward volatility, or if we think that the prices are too high, so we should just put our assets on the sidelines. I said assets, not asses. In these situations, in these markets, especially the ones that go on forever, that have an asymmetric return profile, that is just plain dumb. And it is just plain the wrong thing to do. But it is so tempting to do because of the uncertainty that is introduced by volatility, especially when it comes to our money. Because as we've already said many times now, liquidity can give us the option to do the dumb things that volatility tempts us to do. And the only reason we don't do it in most other parts of life is because we don't have the option to do it. It's not securitized. It's not priced every moment of every day. It's not chunked up into little pieces that we can then sell piece by piece like stocks. And we should be very thankful for that. Liquidity is the ability to act, to buy or sell. Volatility presents us with the opportunity to act. The price has changed. But opportunity and temptation are not the same thing. When liquidity gives us the ability to act on real opportunity, it can be powerful and it can be good. On the other hand, when liquidity gives us the ability to act on volatility-driven temptation, it can be powerfully bad. Volatility is the price of admission in markets and in meaningful things in life. And it is an admission price that is absolutely worth paying. Ups and downs are just part of life. Show me a life without volatility, and I will show you a life that doesn't have much meaning or purpose, or much in terms of returns. Probably hasn't had much of an impact. Growth happens through volatility. We should think of volatility as the beating heart of life. We can try to manufacture a flat line, but you do not want a flat line on the heart rate monitor of life, in markets or in other meaningful places. And we should be able to see how bad a flat line would be in our relationships, in our health, in our money, with our careers. And if we can see that so clearly in those other areas of life, and we can be thankful that we don't have the option to hit the sell button on those valuable parts of life when they become volatile, let's maybe consider treating our money the same way. So, what I would like to make a case for is that we should treat our public investments, our money investments, as both fully liquid and also locked in. Liquid in the sense that we should be eager to buy at fair prices anytime we have the ability and capital to do so, but illiquid in the sense that we otherwise stay invested and only sell, only turning our holdings into cash when we actually have a legitimate need or use of those funds elsewhere. Not selling because we think that things are too high or we're waiting for a big price drop. Not selling when things are going down out of fear to try to hold on to what we have, but keeping our team on the field, knowing that they score points most of the time. They'll get scored on sometimes for sure. Downward volatility will come. But the longer you leave that strong team out there, the more upward volatility you have a chance to capture, and the better off you will be. Do not remove yourself from the game. Do not interrupt compounding. Do not lock in losses. Especially in a perpetual game that doesn't end, which is the life that we live and the markets that we invest in. Don't be tempted to do the stupid things that volatility tempts us to do and that liquidity gives us the opportunity to do. Don't forfeit the game when you're down. Don't bench your players when you're up. Okay. Thank you for investing in yourself and in those around you. I will talk to you next time. Okay, here's my answer to the question, what do you think the market will do over the next year? Are you ready for it? It'll go up and it'll go down.